Good morning. Peter Klein, Chief Investment Officer, co-founder of Align Wealth, here with you this morning on June 17th, 2022. And clearly, we've had some volatility in the markets, and we like using this opportunity to chat with you via these recorded videos to keep you aligned with our vision and what we're thinking about markets, the economy, and how best to shepherd and to steward your capital through these capital markets. It's not easy, and it requires active engagement, but it's important for you to know that's what we're doing every day. We are focused, we're researching, we're spending a lot of time trying to understand the best way forward. Now, this particular market flash is focused, it's a short, hence the word flash, it's a shorter one. It's focused on this particular issue that you've heard from us time and time again, called debt. But before we go there, allow me to spend a moment or two with respect to the current market volatility. It is our review at Align Wealth that the current market situation requires further strong engagement. In other words, no longer can investors under the previous regime, they simply could just invest passively and sort of wake up and okay, all is good. Not the case anymore. In our review, we need to be engaged. You have to know what you own, why you own it, what the plan is, what the strategy is going forward from the investment portfolio situation. We've laid out, and we were early on this call last summer. It's already in print, and you can see it on our website and our videos. We were early on the inflation call, early on the keep cash high call, and be in gold and commodities. So we want to make sure you understand that this is still going on, and we are very focused on providing our clients circumstances and the glide path going forward. So first off, proactive. We want to make sure we have a deep understanding of where the markets are and where we see opportunities, and we do see opportunities. But folks, the game has changed, and we have to expand our toolbox. No longer can we simply be a set it and forget it on an occasional rebalancer. We need to be focused and engaged and active. This is the time for active, engaged portfolio management. We have a setup, we have a buy list, we know what we want to own, and we know why we want to own it. We understand the risks, and we understand the opportunities going forward. Review our website to see some of our prior videos and writings about the 4 I's and 1 V 5 theme portfolio, right? It's value, inflation, infrastructure, international, innovation. Look at that. That's where it's guiding us. That's what's helping us figure out where to go. But yes, a different kind of playbook, a different kind of toolbox. We have to use all of our tools, not just stocks and bonds and funds, but everything we could put our hands on to make sure we keep our clients' capital safe and appreciating. It takes time, takes hard work, and lots of study. So that's sort of my message in this difficult week. Let's go to the screen, and I will present to you this flash on the current situation with debt. Okay, so here you see our typical road. And by the way, unless you've not figured this out before, but this road is, let's say, the capital markets or the road of life, right? One's financial life's twists and turns. In Align Wealth, we're looking to connect with a direct line between our clients' objectives and their results, and that's what we're trying to do here. So let us proceed. I don't know if you've ever seen this before, but this is the United States debt clock, and you could go onto this website and you could see this. It's fascinating. It shows the entire the national debt, the unfunded pension liabilities and Social Security, 91, that's $1 trillion. My first apartment in the city was right by Times Square. This is 30 some like 40 years ago. And there was a debt clock right outside, on the street, and they had to give it up because they didn't have enough digits left after a while. $30 trillion, folks. I'm going to walk you through what this means. Bear with me. All right. So what we did is we looked at 1970 versus 2022, sort of a macro setup. Where was the GDP in 1980? That's a typo. 1980 to 2022. And we wanted to look at the differential between GDP 2.4 trillion, 24 trillion. Which is interesting. It's gone up almost in that way, 10x over 30 years, 40 years. Anyway, deficit was 43 billion. Now it's 2.3 trillion, 2% of GDP, 10% of GDP, and you go on to see it. But there are also debt differences as well. 36% the debt to GDP ratio, 123%. That's federal debt. Total debt, 177% of GDP, 370% of GDP. What's brought this to light for us was, of course, the increasing rates that we've been seeing. So we started thinking, what does that mean? We know what it means. What does it mean with respect to this debt pile we have accumulated here in the United States? Let's continue. This is the federal budget, and here we could see the tax revenue pieces here. This is from our friends at Malden Economics, and you could see how from 2000 to 2029, here's where we are, right? This is 2000, right? 2000, yep. So this is where we are, 2018. And so you could see what's happening with projections and actual. The bottom line is we're going hyper here, and that is a major concern, as you'll see going forward. So 2021 figures, Fed spending above $6.8 trillion versus $4 trillion in revenue. There is that deficit that we saw before. So here are the different areas of spending from the CBO, right? Income security, Social Security, health, national defense, Medicare, as you go further. So this is where the United States spends their money, okay? Now, this is that same Malden Economics graph, but it's as of now, 2022. Before it was 2018. And you can see here's the pandemic, right? And so again, the CBO projections are going up towards $9 trillion, right, of debt. $9 trillion. I want you to look, this is going to come back to this in a second. I want you to look at the net interest. Because the net interest is where I think you're going to see some interesting numbers. So let's assume that is approximately, what we'll call this, about $1 trillion more, right? In that, it's about $1 trillion in net interest, right? And so we'll come back to that. That's an interest expense, net interest expense. Okay, so again, 1980 to 2022. Here's where the chickens come home to roost. Not sure exactly what that means, but I'm not a farmer. I shouldn't know that. But I suspect it has something to do with hitting a fan, or something hitting a fan, right? Okay, 17.19% Fed funds rate. That was the rate back then. Can you imagine that? 0.83. It's up now, obviously, with the recent move from the Fed. Interest expense on the federal debt, $32 billion, $428 billion. I'm going to come back to these numbers. If interest rate expenses were to go up, if rates were to move 300 basis points, and by the way, folks, we're more than halfway there already this year. So if they go up 300 basis points, we're looking at an additional $910 billion of interest expense. So now that additional interest expense versus GDP is 3.7. It used to be under the 1980s only 1. So basically, when you look at it, we got $3.3 trillion of interest expense, assuming that increase, right? And going back in 1980, the rates were already high, but now they're going up, and we've got so much more debt. So now we're talking about a total of $6 trillion. Remember when we were back here, it was 1 trillion? We're going to 6 trillion if this happens. That's a 6 times more in interest expense on all the debt. That's an issue. Because what are we going to cut to be able to pay for that? You go back to this. What are we going to cut? You're going to cut health? You're going to cut national defense? I don't think so. I don't think so. So something's got to give. Well, there you go. Somebody's got to give. This is from our friends again at Walden. And it just goes to show you how the deficits can just balloon. And of course, the debt does as well. And that doesn't include the present value of future social programs like Medicare and Medicaid. So this is where it gets scary when you imagine the debt service and all this. The purpose of this is not to frighten anybody. The purpose is to make sure you understand what we're thinking. One needs to be careful. One needs to be proactive. And we have to be opportunistic. Of course, there are opportunities. They may be international. They may be in certain sectors. Clearly, there are opportunities in, we've mentioned the water sector time and time again. We like 5G. There are certain areas that we think are very exciting. And there are certain stocks that get, remember the pendulum discussion we had in the past? The pendulum is swinging, and there are opportunities to take advantage of. I want to wish all the dads out there a happy Father's Day. We're here to serve. We're here to help. Please let us know where you're at. And if you have any questions, we're happy to discuss it and flesh them out with you. Review your financial plan, review your portfolio. We want you to understand every piece of your portfolio. We do. That's what we do. So we want you to as well. Okay. Thanks, everybody. Have a great weekend.